What's up, everyone? It's Scotty with MoneyVest. So wanted to break down the comments from Dalio that basically suggested, and what he's saying is that cash right now is a better investment alternative relative to bonds. And that is a very, very important topic of conversation because I know on the surface it may not seem like whatever, Dalio is favoring cash over bonds. Who cares? But there is a bigger problem here because of the level of debt and how interest rates are directly affected by the level of demand and supply. So I'll break that down in this video. We've talked about it a couple times in our previous videos and our live streams as well. But of course, the more the demand starts to pull back, the more there is supply in the markets, the worse it's going to be for both bonds and more specifically for equities. And that's what we're here to discuss is the stock market. So hope you guys enjoy this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included, as well as the members only private videos and the intrinsic value spreadsheets as well. So again, link's going to be down below and we'd love to have you on board. So this right here was a catalyst from today on Friday. Dalio says to hold cash temporarily, but don't buy debt and bonds. And the key word here obviously is temporarily, because we know that equity markets over the long term have outperformed both cash and bonds. So it doesn't make sense to hold cash for the long term because inflation eats away at that purchasing power. So right now, for example, I'm sitting on about 24% cash. And that's, ideally for me, it's a very high level. I like to be somewhere between, as I mentioned before, 8 to 20%. And again, in very rare occasions, I go down to as low as 4 to 6%. Back in October, I did dip below 8% because I was buying, stocks significantly. Like I was literally throwing money into a fire pit as stocks were selling off. But then right now, I'm a little bit over the 20% threshold because not only am I saving for some real estate deals, I'm also saving for some other projects as well. And again, I do expect the markets to right now be trading at a little bit of a premium. So they are a little bit more on the higher end of my fair value. So I'm not really excited, or I'm not, super aggressive in my buying endeavors right now. Of course, I'm still dollar cost averaging in some of the more broad-based ETFs. But when it comes to individual stocks, I'm not really aggressively buying at the moment. Now, this right here were some of the comments. So he says, and I quote, "I don't want to own debt." Now that one line is very, very important because that represents demand. Okay. He's the biggest hedge fund manager in the world, the Bridgewater Associates. It's, one of the biggest hedge funds in the world. Now, "I don't want to own debt" is such an important line because that represents demand, right? Just like I'm saying right now that I don't want to buy stocks. What does that do? That represents my demand, right? That represents that my demand is really low. Like if I'm not buying aggressively here, stocks or equities, that means that my demand is low, right? And of course, Dalio coming out and saying that I don't want to own debt represents that his demand for bonds, both government and corporate bonds, is really low. And he says, bonds and those kinds of things. And he further goes on by saying, temporarily, right now, cash, I think, is good and the interest rates are fine. I don't think it will be sustained that way because it's pretty obvious. I mean, interest rates for cash is not going to be, sustainable forever because inflation is going to be a little bit higher. And eventually, it's possible the rates do come down. But he did mention that the 30-day U.S. Treasury bill climbs about 5%, while investors can get 4% on CDs and high yield savings account, right? So you can go out there, online savings accounts paying you 4%, 5% even in some cases, money market funds paying you a much higher rate as well. So there's no need for us to be looking at bonds at the moment because think about it for a second, right? There's a significant flight to quality that happens when bonds, which are risk-free, very similar to cash, start paying you a much higher rate of return. If cash is paying you the same amount as bonds, there's no relative opportunity in bonds. If the cash is paying you the same amount as stocks, nobody would be investing in stocks, right? If the forecasted growth in stocks and the earnings yield and the dividends yield in stock market is, for example, let's say we are in a new universe and it's at 3% or 4%, nobody would be in their right mind investing in the market and take on that additional risk because cash is paying you 4% risk-free. It's literally risk-free, right? You're just stacking cash and the banks are paying you 3 to 4%, whatever the case might be. So there's no need to take on additional risk. Now, with bonds, the reason and when we actually do see a flight to quality is when the rate continues to go up, right? Investors need to be compensated for the higher risk that they're taking on. And for that very reason is what Ray Dalio mentioned, that risk premium is not really there yet, right? The bonds right now, 4 to 5%, you can get a very similar rate in cash. And that's why the yields are also moving up. So you can see that 10-year yield right now is up another 80 basis points, pretty much getting back to the same level as where we were back in August of last year. So, or actually August of 2023. And if you come back to where we were back in October of last year, we're at the same level. We're at pretty much at the same rate as we were back in October of 2022. Now, he also goes on by saying that, and this is a little bit more of a different tangent, but he says that Dalio says the biggest mistake that most investors make is that believing that markets that performed well are good investments rather than more expensive. And that is so true, because as we kind of get involved with recency bias, as we start to see markets go up, we believe that these are good investments, as opposed to thinking that it's getting more and more expensive, right? As prices go up, risk goes up with it. And as it becomes more expensive, risk goes up with it as well, which obviously is not the best way to look at it. We have to understand valuations. We have to understand the risk and reward, right? Just because an investment is working out doesn't mean it's a good investment. It just means that it's getting more expensive, so to speak. Now, when it comes to debt levels, he says that obviously addressing the rising global debt, the hedge fund manager pointed out that when debt accounts for a substantial share of country's economy, the situation tends to compound and accelerate because you have to have interest rates that are high enough for a creditor and not so high that they are harming the debtor, right? So you have to find the right balance. And right now, that balance is not there because there is a significant imbalance in the economy, which I've talked about in the past, because right now there is a significant oversupply of both government and corporate debt. September was one of the biggest months for corporate debt issuances, about $120 billion among 40 companies globally. And not to mention government issuances have been significant as well because the fiscal policy is running a deficit and the tax revenues are 10% lower from compared to last year. And guess what? They are issuing more and more debt. And to top it all off, the Federal Reserve is also lowering their balance sheet, right? They're reducing the size of their balance sheet by tapering off the current existing securities as they are maturing. They're rolling them off, right? So not only is there additional supply, if investors start selling the bonds as well, that's the imbalance between demand and supply, and that's what causes interest rates to go up in the first place. So he says, and I quote, "We are at a turning point of acceleration, but the real problem comes when individuals or investors don't hold bonds." And just like Ray Dalio mentioned earlier, that he doesn't want to own bonds, right? That represents demand. If more investors start to think in that way, that most individual investors or institutional investors, hedge funds don't want to hold or own bonds because it comes as a supply demand, one man's debts is another man's assets, then obviously there's going to be a sell-off in bonds, right? Bond prices are going to come down because demand's starting to go away. There's more supply. Prices come down, and as prices fall, yields start to rise. And as they have an inverse relationship, again, we've talked about these, in the past. Borrowing costs will increase and drive up inflationary pressures, thereby posing an uphill task for the central banks. And that is probably the worst place for central banks to be, because when interest rates go up, the central bank then has to make a choice. Do they let them go higher and deal with the consequences of higher interest payments on the debt, which we also looked at in the federal, not the federal, but the Treasury budget, forgot what the name was, but it was the Congressional Budget Organization, or Congressional Budget, which was released on September 11th, right? They mentioned $600 billion worth of interest payments on the debt. So central banks will then have a choice, right? Whether to print more money and buy the debt from the fiscal federal Treasury Department and keep interest rates lower. So in other words, create that artificial demand, or to let interest rates go crazy, go freely higher, and deal with the consequences, which is going to be the potential for interest payments on the debt going higher, and that's obviously a debt cycle, debt crisis that we've talked about, and of course Ray Dalio has also mentioned. So and that has inflation. So printing more money obviously will have inflationary consequences. And he goes on by saying that we're seeing that dynamic happen now. I personally believe that bonds longer term are not a good investment. He stressed by basically mentioning that interest rates are going to be higher for longer, or basically are going to continue to increase if there is that imbalance in supply and demand, which obviously could put an impact on equity prices and premiums as well. Because we know as yields continue to move higher, right now they're not competitive, right, to the cash rate, to the savings rate, to the CD rate, to the money market rate. But as they continue to move higher and the demand supply continues to be imbalanced, at some point there is going to be a little bit of that flight to quality, away from equities, maybe away from cash over to bonds. Again, temporarily, because long term, I don't believe either they're going to be long term investment worth making. But that's where we are at the moment. That could put pressure on equity prices because everything is a function of the risk-free rate. And as we calculate the discount rate, we calculate the alternative investments. Everything is a function of the risk-free rate, right? We're all looking for alternative investments relative to the risk-free rate. Otherwise, if the risk-free rate was 7, 8%, 10%, 12%, nobody would be investing in stocks. Nobody would be investing in cash, right? Everybody would just buy and hold bonds because the rates were higher. But we're not there yet. So that is something to keep in mind. Hope you guys enjoyed this video and find it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. Let me know your thoughts down in the comment section below. These are things that we have already addressed, right? These are things that we're just kind of kicking down the road, kicking the can down the road because the debt levels, nobody wants to talk about it. Debt levels, nobody wants to address it. But we're doing these periodic videos just to keep ourselves up to date with where the debt levels are, where the interest rates are, and how that could impact the overall equity markets in the US. So let me know your thoughts down in the comment section below. As always, make sure you drop a like, subscribe to the channel. Link to our Discord, Patreon is down below. As always, happy investing. I'll see you all in the next video.